Welcome, everyone. My name is John Giordano. I'm a partner and co-leader of our firm's manufacturing and distribution practice here at Citrin Koopman. I'll be serving as today's moderator. Joined today by my co-leader, Mark Henry. He'll be handling the Q&A portion of the discussion and our panel. I'm going to introduce momentarily. Just want to give a little background on the firm for those of you that may not know us. So Citrin Koopman is a national leader in providing accounting and advisory services to the manufacturing and distribution industries across various different subsectors, spanning from food and beverage to housewares, home goods and textiles, beauty, cosmetics, industrial products. We have experience and expertise in providing customized solutions to the core middle market that span not only our traditional services, such as audit and tax compliance, but also a full suite of advisory solutions, many of which will be on display today. So about today, as many of you know, every year we poll 200 plus executives in the manufacturing and distribution industry to get a pulse on the economic and competitive factors that may be affecting the industry all across the U.S. Originally, results were presented in June, which we consider part one of this kind of webinar series. Our report this year, entitled Elevating Your Business Performance, is available on our website for anybody that wants to peruse it. And again, fast forwarding to where we are today, today's part two of the session entitled Navigating for the Future, Strategic Planning for Manufacturers and Distributors. Our part today, the webinar will focus more on forward-looking, taking into account not only results from our survey that we did and presented back in June, but looking as we wind down 2024 and looking to 2025, our panelists will discuss, several key things to consider, especially as we all know with the recent results of the election. So, right. I guess at this point, I'm going to introduce our panel. I'm going to start with one of my partners, Bob Alperin. Bob's a partner and leader of Citrin Koopman's Federal Credits and Incentives practice. Bob has been specializing in R&D for the past 20 years with extensive experience leading our R&D credit studies, assisting clients with IRS and state audits and controversy related to research and development credits, and a whole lot more. Next, we'll have Dr. Anirban Basu. Dr. Basu has joined us in the past. He's the CEO of Sage Policy Group. His firm focuses on providing economic and strategic analytical services to manufacturing distribution companies and various other sectors throughout the United States. Eric Saza, managing partner here at Citrin of our digital services practice. Eric has more than 27 years experience leading information technology organizations and enterprise solution programs and strategy, ERPs. That's what I call them. Harper Garrett. Harper's a director here on a transaction advisory services practice. He has 15 years of experience working on various due diligence deals from either the buy side and sell side perspective, with clients focusing on manufacturing and distribution. So that's a panel for today. Like when we kind of putting this program together, we kind of want to focus on like four major areas. So we're going to have an area like around our economic update, some macroeconomic tax implications, workforce job creation, and really a pulse on the M&A market a little bit. So I think kind of a diverse panel here will be able to touch on a lot of these. And before we kick things off, I just want to remind everybody, submit all your questions through the Q&A button on the bottom or through the chat so that we can monitor throughout. We'll probably address most of those towards the back end, but my partner, Mark Henry, will be moderating that. So please send those through. And also, just a quick thing, as we proceed throughout our panel discussion today, please remember that everyone's personal and political beliefs may differ a bit. So we ask that everyone keep the discussion bipartisan and focus solely on the economic issues at play here. So, okay. I think that's enough for me, right? I think everybody would agree. So let's kick it off with our economic update section. So I'm going to start right with you, Dr. Basu, if you don't mind. So right off the bat, let's come out of the gate. What are the major policy changes you think are likely given our new president and Congress? Big change.
Yeah, well, I know we've got a lot of questions to get through, so I'll try to hit it in a quick fashion, but two very pro-growth elements of what the Trump administration is likely to bring to Washington, D.C. when Inauguration Day occurs Monday, January 20th. And that's obviously lower corporate taxes, lower taxes overall, as it turns out. That's pro-growth. By the way, a lot of people worry about the deficit implications of that. But if you look at just corporate tax collections, federal corporate tax collections, they have surged higher in recent years because, yeah, the corporate tax rates are lower, but corporations are much more profitable than they once were in the aggregate, at least. Number two, regulation, of course. And one of the things that I think you're going to see, and we're going to get to this, of course, but you're going to see a regulatory environment that's much more favorably inclined towards mergers and acquisitions. Not all mergers. So I think the Trump administration is going to continue to push back on the Nippon Steel, U.S. Steel merger, if that's not completed by Inauguration Day. But, and we'll see, Nippon Steel, of course, is trying to push it through by Inauguration Day. We'll see how that goes. But otherwise, generally speaking, M&A is going to be very strong in the airline industry and other industries, but we can talk about that more later. Now, two policies that I think could be negative to growth: higher tariffs, of course. Now, if you're a manufacturer of domestic U.S. steel, then you love the idea of tariffs, and you're going to make the case that the Chinese are dumping steel and so on and so forth, and that there's all this excess capacity, and we need to protect these very important jobs. Fair enough. But if you're a producer of tractors or automobiles and an importer of steel, then of course you're not going to be so favorably inclined. And we economists are trained not to love higher tariffs. And then finally, immigration, of course. Harder line on undocumented migrants in particular. And what that would be is effectively a negative supply shock to the labor market, meaning that labor becomes much more expensive, certainly in certain categories of endeavor: construction, landscaping, agriculture, hospitality, so on and so forth. So some pro-growth, some negative growth. I don't want to be partisan at all, but generally speaking, most economists view this overall as pro-growth, though not every element of the platform is pro-growth.
In going through that, I know you mentioned could be some increased pricing in terms of labor and whatnot. How do you feel the Federal Reserve will respond to the policy changes?
So right now, they're not going to respond at all. So what they're saying is, you may have seen Neil Kashkari this morning, who's president of the Minneapolis Federal Reserve. You heard last week from Jerome Powell, press conference on Thursday after they had cut rates by a quarter point, that we're not taking this into consideration. We don't know what Congress is going to do. We don't know what the president's going to do. We have a meeting in December in front of us. My guess is, despite today's somewhat hot inflation numbers, we're going to get a quarter point rate cut in December. And then the Federal Reserve has always, these policymakers have always taken fiscal policy into consideration in their deliberations. So they're going to look at what the Trump administration is proposing. Is it inflationary? Are we going to get those 60% tariffs on Chinese goods? Because I can tell you, if we get 60% tariffs on Chinese goods, which it's doubtful, but if we did that, the Federal Reserve would not be reducing interest rates at all in 2025. So we'll see. But right now, the attitude is, let's see what happens after January 20th. We're going to cut price rates in December, and then we'll watch and see what happens along with the rest of us.
Thank you. Thank you. Bob, I have something for you, but just before I get to you, because we mentioned the M&A market and the slowdown a little bit, that depending on who you talk to, the market's been a little bit slow, but what are the key impacts? This is more directed towards Harper, of course. What are some key impacts that the election results will have on deals within the manufacturing distribution industry? Because like I said, depending on who you talk to, it seems like there's a slowdown, that tied in with rates and whatnot, but I don't know. I'd love to get your thoughts.
Yeah, no, absolutely. And I think Dr. Basu hit on a lot of the key points that are going to impact the M&A market, specifically tariffs, the corporate tax rate, and just the general regulatory environment. I think a lot of firms are in sort of a wait and see mode for now until the policies actually get enacted. Nothing's happened yet. So they haven't seen a lot of strategic shifts in deployment of capital or anything like that until they actually see what comes through. But tariffs is a huge one, obviously. I think that can be detrimental to international deals, while at the same time also, maybe potentially a boost to the domestic M&A market, where companies look to onshore more of their, critical supply chain needs and operations in order to, reduce that global risk and get more control over their costs. I think the corporate tax rate coming down is going to free up a lot of capital for companies to potentially use to reinvest in their, business through acquisitions. And then also I see the potential for Trump to focus on, domestic infrastructure and put programs in place to really build that out, which could have a significant boost for specific industries within the M&D market, such as, construction materials, equipment manufacturing, logistics, things like that could see a boost in terms of increased M&A activity.
Right. Before I move to Bob, Dr. Basu, do you have any further comment on that, or?
Well, I think you're going to see a ton of consolidation in certain industries. And generally speaking, it's going to be quite good for corporate profitability, right? You're going to have more market power. Again, if the Trump administration had been in charge, and I'm not saying this is good or bad, but they probably allow that Spirit Airlines JetBlue deal to move forward. And now what we're seeing is Spirit Airlines is on the verge of bankruptcy, right? So I think what you'll see is much more consolidation, much more pricing power. It's good for corporate profits, so on and so forth. That's part of the pro-growth story here. And I can see that M&A professionals are just chomping at the bit, right? The M&A attorneys who haven't been that busy in the last couple of years, the financiers, others, they're waiting for that combination of a better regulatory environment, lower interest rates. And again, we'll see what the tariffs do on that front, right? Because if we have tariffs, they're not going to get lower interest rates. And so that kind of catalytic effect on deal making won't be there. But I would think that by 2025, 2026, we're going to see a lot more M&A activity and also initial public offerings. That's what this economy is probably going to produce.
Okay, going to switch gears here more towards tax policy. So under President-elect's past administration, we saw the Tax Cut and Jobs Act come into play. Significant tax policies obviously impacted manufacturing distributors associated with that. We had 199A, the R&D credits, 174, 168J. I'm spitting out stuff that Bob wrote to me because I don't know this tax code. But do you see any relief coming, Bob? I mean, in the coming. I know a lot of this put a lot of strain on companies in terms of managing, especially with the interest rates where they are. You know, the interest rate limitation. You know, the change in how the R&D credits are now accounted for. So, you know, love to get your thoughts on that.
Sure. You know, in the short term, I don't see any relief, and I'm talking over the next several months, right? Instead, I would expect that there'll be relief as part of the proposed tax reform in 2025. We already know that Trump wants to reduce the corporate tax rate from 21% to 15%. You know, but there are two key proposals that are out there that we should keep an eye on. One is the Tax Relief for American Families and Workers Act of 2024, and the other is the American Innovation and Jobs Act, which was introduced by the House in March of 2023. Both of these have bipartisan support. So in terms of the Tax Relief for American Families and Workers Act of 2024, it passed the House in January of 2024 by a vote of 357 to 70. So overwhelming support, okay? And in August of 2024, probably due to the upcoming, you know, the election, the bill was blocked by the Senate in a procedural vote. This act has several taxpayer favorable benefits associated with it, as well as some not so favorable benefits. But some of the good ones are that, one, it would restore the Section 174 R&D cost expensing. You know, that's a big issue for companies these days, especially in the M&D space. You know, having to capitalize R&D costs and not being able to expense them currently. This act would restore Section 174 expensing for U.S.-based R&D investments. However, it would not restore the current expensing for foreign R&D expenses, and those would continue to be capitalized and amortized over 15 years. In this proposal, it is retroactive to January 1st, 2022. So that could be something very significant. So definitely we want to keep an eye on that. Another favorable benefit is that it extends the application of the interest deduction based on EBITDA for Section 163J purposes. EBITDA gives you a better answer, a higher interest limitation. The act also would extend bonus depreciation back to 100% under Section 168K. You know, the bonus depreciation has been ratcheting down each year over the last several years, but that would be a nice benefit for taxpayers. On the flip side, you know, there is for R&D credit purposes, there's the reduced credit election under Section 280C, and with the changes in Section 174, there was this, I'll call it a loophole, where companies didn't have to reduce their R&D expenses by the amount of the credit if they had the right facts. But this act would do away with that loophole for years beginning in 2023 and after.
Going through everything that you've gone through, the potential changes and everything like that, Bob, do you foresee any evaluated tax planning ideas for the 2024 year-end season?
Absolutely, absolutely, right. So anytime, we're talking about a reduction in the corporate tax rate. So if we go from the current 21% to say 15%, we should be thinking about, just good old tax planning advice. Accelerating expenses in 2024, deferring income into 2025, and presumably the tax rate would be less if the 15% tax rate were to go into place. So when we think about accelerating expenses, deferring income, it's usually in the form of a change in accounting method. So that's something to keep in mind for year end. Changes in accounting methods need to be filed on a Form 3115. The deadline, there is a deadline for non-automatic accounting method changes, which is December 31st for calendar year end companies. So keep that in mind. Some oldies but goodies, accrued bonuses. If you pay out your accrued bonuses within 2.5 months after year end, you can deduct them in the current tax year. Prepaid expenses, if you prepay an expense, but the right or benefit associated with that prepayment is doesn't go beyond 12 months effectively, or beyond the subsequent tax year, then those costs can be deducted currently. In the M&D space, we should be thinking about inventory write-offs. If you have, inventory that needs to be written off, need to dispose of it or scrap it, and track that. Obviously, in 2024, a lot of natural disasters, hurricanes, and etc. So we should be thinking about casualty losses under Section 165. I mentioned Section 174, R&D cost capitalization earlier. There's been a litany of guidance from the IRS related to Section 174, and some of the guidance is very specific to software development activities. And I would just, warn taxpayers, be careful not to overcapitalize your R&D costs, right? Obviously, you don't want to overcapitalize. And there are certain items that the IRS has come out with and said don't need to be capitalized or not specified research expenditures. So keep that in mind. One other item, just a couple of other items just to note, proposed regulations for Section 174 are expected to be issued in Q1 of 2025. In addition, from an R&D credit perspective, there is a revised draft Form 6765. This is the form that you use to claim the R&D credit. Instructions are expected to be issued by the end of this year. This new form goes from a 2-page form to a 4-page form and requires a significant amount of additional information. It's not required with your 2024 return. It's optional, but it's mandatory for 2025. And there are some exceptions to that. There's a section called Section G, which requires a lot of information related to the different projects that were worked on. And that's not required for companies that have that are qualified small businesses, or companies that have less than $1.5 million in qualified research expenses and have less than $50 million in gross receipts. So there's a lot happening on the tax side, John, and we'll try to keep people as updated as possible.
Well, as you're going through, Bob, I'm taking, jotting a couple notes down and kind of transition, because definitely want to talk about workforce, job creation, and I'm going to throw technology into that bucket as well, because I think as companies continue to struggle with workforce and the retention of employees, we see more and more companies introducing technology, right? And what does that mean? That also interplays to what you're talking about with your R&D credits, right? And that type of implementation. So I'm going to start at a broader level. I'm going to go back to Dr. Basu for a second. I'm going to ask him, again, with workforce and technology kind of tied in as one here, with the changes in administration, what effect do you think the president-elect's policies will have on the jobs market?
Oh, I think workers become more expensive. I mean, the Brookings Institute conducted a study earlier this year that was just fabulous, that broke down U.S. population growth. Just fantastic. I mean, first they asked the question, well, is population growing as quickly as we thought? Well, it's growing much more rapidly than we thought it would. So instead of growing 1 million people per year, it's been growing 3 million people per year. So then they asked the question, what's the delta? Why? Is it because of births minus deaths? Are fertility rates up in America? No, they're way down, as you know, below 1.7. So what is it then? It's immigration. And then the Brookings folks asked the question, well, what kind of immigration? Is it documented or undocumented? Undocumented. That's the big delta. And of course, that's predictable. Everyone, on this webinar knew that that was the case. But, the Brookings folks actually did the analysis and figured out, how many undocumented migrants probably have come to the country, let's say, over a given 12-month period. And then they asked the question, what are these undocumented migrants doing? They're working. They come here to work by and large. And there's this plausible deniability. They're brought to employers through labor brokers and so on and so forth. They have, for some reason, a tax identification number, though they don't have a social security number, all these kinds of things. And so they're working. I mean, you look at the roofs of America. Who is maintaining the roofs of America? It's, foreign born is the majority in many of the communities across the country. Who's making the hotel beds? So my point is this. We have this inflationary factor, which is, of course, wage pressure. It's still there. The U.S. unemployment rate is 4.1%. If you take a bunch of prime age workers out of the workforce, and for good reasons, I get it, the law has been broken. I'm not saying we should have an open southern border, but it would be a negative shock to the labor market, taking away a lot of service workers in particular, and that's inflationary. And anything that's inflationary leads to higher interest rates. But, a lot of these policies are really quite inflationary. One thing that caused me to think that the Trump administration will not, in fact, implement a lot of these things is because President-elect Trump cares deeply about the stock market's performance. And some of these things would hurt corporate earnings, of course, and therefore would hurt the stock market's performance. And he certainly doesn't want that. So we'll see what happens. But a lot of lack of clarity out there regarding labor market dynamics going forward.
Yeah. And listen, as a practitioner in this space for many years, working with manufacturing distribution companies, the workforce in general, as I alluded to before, has always been a struggle, and I think it's a hot topic that continues to warrant conversation, even without the factors that are coming down the pike from the recent change. And what we've seen in the market is I don't think you can go anywhere without people talking about AI and different types of technology. So I do want to shift to my digital services partner Eric for a second and ask him the question. What are the biggest trends and systems you see, or that the audience should be aware of going into 2025 as people continue with, you may see some of the manualized labor kind of deteriorate a little bit, but what could companies be thinking about in terms of automating some of these processes and whatnot?
Yeah, great question, John. I think we see two kind of major trends going into 2025. I think the first one, as you mentioned, is AI. I don't think you can have a conversation about software and tools right now without talking about AI, but there's been so much hype about it over the last year and a half. I think a lot of leaders are struggling with where should they start on their AI journey and how can they get meaningful productivity out of AI now. So I think that's one trend to talk about. The other one, which is kind of a new one in a sense, is really end of on-premise systems. And for a long time, companies have had these on-premise systems out there. There's been cloud versions. There's been a lot more advancement in the last couple of years in these cloud platforms. There's a lot of companies that are still on-premise, in particular ERP platforms, and you're seeing major vendors like QuickBooks, for example, announce the end of kind of the desktop version. You're seeing Microsoft Dynamics, Great Plains do the same thing in terms of end of life or support where you can't buy new licensing. And so for a very long tail of companies, particularly in manufacturing and distribution, they're going to be forced to make a move to a cloud platform over the next year or two as they contemplate their strategy. So those are really two of the key trends. From the AI standpoint, there is a lot of things that people can do now particularly from a generative AI standpoint with tools like Microsoft Copilot to get gains. They're really the two major categories under AI where there's immediate benefit right now is language, anything related to language generation, language transcription. We, for example, have a client that has a lot of field team members that go out in the field and they were taking shorthand notes. Those would go back to 3 different people that would then transcribe those notes to longer detailed notes that would go out to the client for billing. Well, using an AI model, we were able to implement that. So those shorthand field notes can be automatically transcribed, can generate a confidence rating. With a high confidence, it can go out automatically without having anybody to touch it. So that's just one example on AI around language. The other one is really around data analysis. And if you look at things like an order to cash cycle that may start in a CRM system, then go to an ERP system, and then go to a warehouse management system and cross several platforms, now you have the tool sets available to overlay the data and analysis to look at that entire order to cash cycle and see where can we tighten that and where can we make that faster. Not only where can we figure out how to make that faster, but how can we predict that so we know when order volumes are coming up or back orders are taking place, what needs to be adjusted ahead of time to make that process smoother and more efficient and increase customer satisfaction. So those are just a couple of things on the AI front that are kind of front and center that people can start with now. And I think one of the biggest things for them that's going to be a challenge, and just the workforce in general, is teaching people how to use AI. As these AI tool sets come out, people have to interact with them differently and have to think about how they work differently, how they enter prompts, and how they can get the most benefit out of it. Because there is huge productivity gains, but they have to think different about how they do that as well. Secondarily, I'll just keep going here for a second. Sorry, John, but on the end of life system part, as people are forced to make these changes, they should think about it as an opportunity, because there's been a lot of advancement in these cloud platforms that hasn't happened on the on-premise platforms, particularly in things like e-banking and things like automation of AP and AR and payments and receivables collection that they can take advantage of. And they need to think about their kind of entire software ecosystem out there, because all these systems are integrated and connected together, and some play better in the sandbox than others. So as they think about this, they need to evaluate the whole ecosystem, and they need to think about the opportunity that they can get by, and not just being kind of forced to make the change.
Well, that's the question I was going to kind of interject a little bit as you were going through, because, we talk about it in such a huge topic. But how should people be thinking about their AI strategy? Like, how does one start to kind of explore that and really get started? Because it's kind of everywhere, right? It's kind of everywhere and all over the place at the same time. You're being told you should do it, but a lot of people don't even know where to start. So, what would your advice be about developing that AI strategy to at least start the process?
Yeah, no, it's a great question, because I get the question all the time. Do I need to hire data scientists and machine learning professionals? Do I need to create my own walled off version of Chat GPT and start dumping my data in there? And I think the answer is AI is really just going to become ubiquitous in kind of all the systems. And so it's not really needed that you develop your whole AI team and hire a bunch of IT folks to do that. And, we tend to think of it, and there's AI embedded within systems, for example, your CRM or your ERP system, and those are getting released by those major partners and manufacturers every 6 months or so as they continue to develop that. And then there's really cross-platform AI and tools like Microsoft Copilot that are embedded in Excel and Word and PowerPoint. And we say that as kind of a good starting place, because it's tools that people are already familiar with today. They can get immediate benefit, what they're doing kind of day in and day out, and they can start to get enabled on that AI journey in a way that's secure as well. So those cross-platform AI productivity tools, we see people starting to take advantage of now, because they're working, they're secure, right? And then they can start getting their users kind of trained and start to think differently. And a lot of these implementations, it's not necessarily an entire technical implementation, and part of it is a technical implementation, but a big part of it is just user enablement and training as well.
Great, thank you. I'm going to shift gears for a second, but I'm going to come back to Eric on the next topic. But I do want to move on to the M&A market a little bit, and I do want to further that discussion a little bit, because I think it's impactful to, like we said, driving the economy and whatnot. from a vantage point, sorry, Dr. Basu, from your vantage point, I know we talked about interest rates and what we think they may or may not do, but can you just give us your thoughts on the impact on valuations and the M&A market and the activity associated with it?
Look, if you're an acquired business, when would you sell? You'd sell when you get a really good price, right? Because you're giving up control, right? You might be giving up a family business, so on and so forth. And so when you have more M&A activity, that tends to raise valuations. I mean, I suppose you could think of a situation in which the economy is faltering and businesses are being sold off because there's significant economic weakness in the macro environment. And so, you know, but that's generally not what we're talking about when we're talking about America. The US economy has been very strong. Corporate profits have been very strong. There's a real desire to consolidate across industries to generate more pricing power, more purchasing power at the firm level to, you know, to drive up both the, you know, top line and bottom line. And so what can I tell you? This stunted M&A activity that we've seen in the last couple of years has not been great for valuations, at least for private firms. And so a lot of the capital is moving to the publicly traded areas. It's like, you know, S&P is at roughly 6,000. You know, Dow Jones is at 44,000. Bitcoin is at over 80,000. All these kinds of things. That's where the money has gone. A lot of the capital. But a lot of that capital is ready to come back into these private acquisition markets, driving M&A activity. We just need somewhat lower interest rates to really catalyze all of this effect and drive up valuations. And then a lot of people can retire, right? They have the liquidity event and they move to Boca Raton, which is, I think, standard practice. So, you know, that's sort of what I'm looking for in 2025 and 2026. But again, a lot of wild cards, and we've seen some questions in the Q&A about immigration and deportation and labor costs results, and of course, tariffs. Those things are inflationary. Those things keep interest rates higher for longer. And by and large, I do not view those things as pro-growth because we'd love to have a lower cost of capital in this country.
Yeah. Harper, what are your thoughts? You know, working in a transaction advisory team, given what Dr. Basu had alluded to there in terms of the interest rates, what do you think of the current economic conditions affecting valuation multiples for M&D companies? What are you seeing out there?
Well, I think he's right. I think, I mean, the interest rate is a key to what the future holds in terms of valuations and where they're going to move and in conjunction with the M&A activity overall. Currently, I mean, EBITDA multiples in the M&D group have been some of the stronger ones that we've seen in terms of industries. There's still M&A activity. There's still a lot of businesses that, like you said, are family-owned businesses that the owner that built the business or the founder is looking to retire, doesn't have kids that are taking over and wants to sell. COVID really, you know, put a hold on that as business became interrupted. And now that things have, you know, more normalized and come back to pre-COVID levels in terms of shipping rates and a lot of the supply chain issues have been resolved, things like that. You know, those companies are looking to go back to market. And given that the, you know, depending on the policies, if the interest rate goes down, I think we will see a lot more of the capital move back into investing in those companies that may have been sidelined, including, you know, smaller independent sponsors and smaller firms that may not have had access to as much capital and, you know, more in the borrowing market may have been sitting on the sideline due to the high interest rates. Will get back into purchasing and being involved in those transactions, which I think will help drive the multiples up. Currently, I mean, in a lot of my clients, I'm seeing multiples between like 7 and 10. EBITDA trailing 12 months for manufacturers, depending on the sector. I think technology is going to be one of the big sectors. We've seen a lot of growth in that. I mean, the CHIPS Act in 2022 put in place about $50 billion worth of subsidies for bringing back semiconductor manufacturing to the U.S. And expanding that base as part of just, you know, increasing U.S. Capabilities in that sector, as well as a national security perspective of bringing that and onshoring it. Given the tensions between US and China and the relevance to Taiwan of semiconductor manufacturing. And I have several clients already that have seen really dramatic growth in their overall top line revenue and EBITDA from that act. So I think technology is going to be a big sector. And I think, but I think really Dr. Basu hit on it. It's really the higher interest rates, where the interest rates go, and, you know, the higher costs that have been associated with the issues that we've had have really squeezed margins for a lot of the M&D sector in recent years. And I think as those factors come down and lessen, I think margins are going to improve. So I think that will help drive valuations up as well.
When we talk about the sector, right, we talk about manufacturers, distributors. we talk about the interest rates, tariffs, everything affecting, but the biggest thing, right, is inventory, right? That's what all of our sector deals with is inventory. And that's a lot of the driving factor. That's what we turn cash into capital, right? The turnover of of the inventory, whether it be the manufacturers bringing in raw goods, producing it and selling it to wholesalers, or the wholesalers taking it in. It's all that movement. So Dr. Basu, does inventory levels tell us anything? I mean, you got some companies that have been marred in a little bit of a downturn. What can that be a key indicator of how companies will potentially come out of any recession and what the tariff impact will be?
Yeah, of course. My goodness. I mean, I've been scrambling here to look at my phone to try to look up manufacturing inventories, inventory sales ratios, also for wholesale trade, meaning distribution segment of the US economy. And what I see is this. I can almost sense a frustration coming from the data, the numbers, the effort by both manufacturers and distributors to reduce their inventories. And they're meeting up against resistance because the US macroeconomy has been weakening. I'll give you an example. Today, we received a data point on inflation from the Consumer Price Index. Okay, set that aside. But one of the things that was noted in that report is that goods inflation is not very prevalent, right? Mostly inflation is in the service sector, which relates to wage pressures, but not in the goods sector. Now, economists talk about this, say, well, this is wonderful, we have less goods inflation. But if you're a manufacturer, this is not good news, because what that speaks to is your lack of pricing power. And why is there lack of pricing power? Because in many segments, at least, there's still too much inventory. And that's also true at the wholesale level. So when you look at the Institute for Supply Management's Purchasing Management or Purchasing Managers Index, it's still below 50, still saying that US manufacturing is in recession and has been for the better part of 2 years now. I think the last 7 readings have been below that threshold of 50, signaling that we're still in contraction mode. And so those stubbornly high inventories tell us a lot because they tell us about future pricing power, that manufacturers and at least certain distributors as well are going to have to continue to keep prices lower to move that inventory out. Well, that, of course, is bad for margins. And that's also bad for new orders, as it turns out. So yeah, I think inventories tell us a lot. It's fascinating how the inventory cycle works. We have this flat inventory for a while, and then it surges again, and then it flattens out. Right now, we're in a flat period in terms of inventory build, but inventory is still stuck at stubbornly high levels.
Yeah, so it's interesting to continue to monitor that and see how everything at play kind of ties in. So appreciate that insight. So we kind of went through, some economic issues. We talked about the M&A market. We talked about various different multiples that we could see throughout. So, but also we talked about AI, right? And how does that tie into the M&A market? And Eric, really for you, are you seeing in your practice that it's people getting a return on their investment if they're implementing an ERP pre-sale, or if they should, kind of move forward with what they have? Or, I'd love to get your insight as to terms of, we talk about making that investment, right? Making that leap. But, where are you in your business cycle in terms of sale and whether or not it makes sense to make that leap pre-sale or post-sale? So,
yeah, no, it's a great question. I think a lot of people struggle with that. And certainly as you go through a sales process, one, you need to have your financial house in order, right? So you need to make sure that your financials are accurate, because that's what the due diligence is going to be based on. And whether you go through a QOV process or not, that has to be there. And then you have to produce a lot of data as well, right? For the SIMs and the books that you're putting out. And so some of that's possible, in your existing systems, but it may not be. They may need to put new systems in place even to get their kind of financial and metric house in order, right? So that's one consideration point. The other one is really trying to figure out, what their exit path is, because there's really, if you look at the two potential, main exit paths, if you're exiting to a strategic buyer and you're fairly confident that that strategic buyer is just going to consolidate your systems anyway, basically, then it may not make sense to make that change before a sales process. And certainly one thing to be aware of is not entering into long, 3 or 5 year type agreements, particularly with SaaS platforms, if you think you're selling to a strategic provider. On the other hand, if your sales process is likely to go through private equity, they're certainly going to look at that and want a more robust system in place even before the acquisition, because the first thing they want to do is rapidly grow and scale the business, right? And so as we perform IT due diligence, for example, for private equity companies, the first question we get is how scalable is their platform? Whether they're going to do additional acquisitions and integrate that in, or just try and kind of put investment in and hyper grow it. They don't want to wait 6 months, to be able to do that. And so exiting to a private equity buyer, we're seeing people look at that and kind of discount, right, the purchase price if they know that they're going to have to invest heavily in systems right off the bat. So I think those are some of the trade-offs, is trying to figure out who your buyer is going to be. Most of these systems take kind of 6 months to select and then implement and stabilize, right? So from an overall timing perspective, if you're thinking about a sales process and making system changes, you want to think, probably 9 to 12 months in advance of when likely that sales process is going to be to start making those transitions.
Yeah. Very insightful. I'm just looking at where we are in terms of timing. So I do want to pause here for a second and just ask my colleague Mark to come on, see if we have anything to monitor through the questions, or if you got anything directly.
You got a couple, so keep them coming. I got one via text, one through the Q&A, and one through email. So keep them coming. But I guess one comment to start, and Harper, this kind of goes with your comment before about multiples. Not really a question, more of a comment, but client just asked, hey, is the 7 times multiple what you're seeing, and what does that look like for me? That's something we can help the clients that are on the phone call. That's something we can find pretty easily, as Eric alluded to, by types of buyers, types of segments. So we have comparable information out there. So if that's something you need from us, we can absolutely help you there. Kind of the first question, I feel like, Eric, this is probably towards you. We talked a lot about tariffs, and I know over the last couple of years through COVID and prices going out of control and tariffs coming in, clients had a lot of time, spent a lot of time in their ERP trying to get tariffs in as a loaded cost. And then also, like, how often do they actually push that increased cost out to their customers, right? And how does that track and how does that work? Can you kind of just talk about ERP systems and what you're seeing in terms of, like, best in class people? How are they tracking that information and how are they getting out to their customers?
Yeah, I mean, I think that, struggling with costing is certainly probably one of the most prevalent things for manufacturing and distribution, right? And particularly with the modern cloud platforms, they've gotten significantly better at that relative to how quickly you can apply standard costing and how that's flowing through all your transactions as well. So it's something that we see as probably, when we go through into an ERP implementation, we start off and we talk to people and say, hey, what are really the top 3 things you want to get out of this, relative to the ERP implementation and the reason you're doing it. And 90% of what they may be doing is replacing what they already have. And the last 10% is really the reason they're doing the implementation in the first place, right? So we take a look at that and say, okay, let's make sure we're taking those top 3 things and we bake them all the way through as we do the requirements gathering, as we do the design, as we do the testing. If it's things, for example, like better and accurate costing, right? Whether you're looking at things that are coming over the water and freight coming in and things like that, and how you're rolling that through and applying the tariffs to the cost and dropping that down, that all that is taken in as part of the design. So by the time they go live, they feel very confident that, the reasons they did the implementation in the first place is what they're getting the value out of the system after they go live.
And I think we've seen a lot of people with those changes that they're pushing through is also kind of change their customer contracts to make sure if tariff increases come through, that's in the contract language, so it's all passed through. So that's definitely something to think about. This next one, I think, is probably John and Bob. Grants. So we talked about a lot of different investments that people are making, ERP, we kind of talked about cyber a little bit, energy. How are people kind of dealing with those investments? Are they going to banks? Are we seeing a lot of grant activity? How are we kind of helping people think through that?
I have a few comments. I'll defer to Bob first, but I do have a couple of comments of what I'm seeing. So.
Sure. I'm definitely seeing, grant activities, under the IRA, there's an ability for taxpayers to transfer tax credits, energy type credits, which is really creating a whole new marketplace.
Yeah.
So that's something to think about as well, in addition to, federal grants as well as state and local grants and credits and incentives.
Yeah, I actually had a client in a local client that actually sold some credits in the past year. Like you said, it's developing its own marketplace, brokers, dealers, and whatnot. But we actually came across, here at the firm, we came across other various different types of grants and whatnot, some that are geared strictly to the locality you're in, whether it be state or local tax incentives and credits, which could open up a whole nother can of worms. We could probably do a whole webinar on just that. But one of the things that we did come across is kind of outside of our realm is, tied in with energy usage and consumption. There are grants out there run by the acronyms IAC grants. And what really drew us to it is if you're a certain manufacturer that really falls into our sweet spot, right? 100 million less of gross revenues, 500 less employees, and a certain energy spend. If you couple it with a energy audit and they make certain recommendations, and if you implement those recommendations, a lot of which our clients have gone through, and even some projects they were already planning on doing has fallen within that acceptable range of qualified projects, you can get substantial grants associated with those projects, running up to 50% of the spend with a cap of $300,000. That's real money coming back. So we've kind of discussed that with a couple of clients. I know Mark, I think you have as well. We just had a call the other day. So yeah, again, the keywords here are manufacturer by your NAICS code. If you have less than 100 million in revenue, less than 500 employees, and a certain level of energy spend, I believe the cap is 150 to about $3 million of annual spend. You could qualify for these types of credits for certain projects. So
yeah, and
pretty interesting stuff. Like I said, it's real money coming back too.
If you're thinking about, if you're with tax planning season for us right now for calendar year end clients, and if you're thinking about investments, even AI, there's a grant in Massachusetts for if you're making a purchase of AI robot, there's grants available for that too. So reach out to us. That's part of, hopefully what we're trying to bring value for. But that should be part of the investment process, right? Hey, I want to make $1 million investment. There's grants to help supplement that. What does that look like? Harper talked about the semiconductor industry earlier. So those are really, really important things. The CHIPS Act has grants available there as well. I think the last question, unless anything else comes in, is, and Dr. Basu, you kind of touched upon this earlier. So if there is a significant change in the immigration policy, whether people coming in or people leaving, what impact do you think that will have on the workforce?
Well, it depends, right? Because as I understand it, in manufacturing, and there are various estimates out there, only about 200,000 undocumented migrants work in the U.S. manufacturing sector. And compare that to restaurants, 1 million, construction, 1.5 million. So, and much of that is in residential construction, as it turns out. And so, if you're talking directly about manufacturers, the push to deport, mass deportation, so on and so forth would not have tremendous impact on, I don't think, the U.S. manufacturing sector, as it turns out. Some, but modest, limited. But there is another issue, of course, which people tend to focus less on, which is documented migration, legal immigration, right? Issuing more visas to workers in technology and manufacturing and finance and so on and so forth, or seasonal workers working in agriculture, that kind of thing. So I think the Trump administration actually is open to legal temporary migration to support businesses during seasonal periods, or when if the U.S. economy is growing and manufacturers saying we need more workers, say, look, we're going to issue more visas of certain type, H-2B, whatever visas it happens to be. I think the Trump administration is actually okay with that. I don't think they're okay with undocumented migrants and a chaotic southern border. That clearly they're not okay with. And so it may be the case, and this is maybe me being hopeful, that even as the Trump administration gets tougher on the southern border and fewer undocumented migrants come to the country and more are deported, that there is some relaxation of some of these visas, visa restrictions in terms of caps. The Biden administration has maintained very strict caps on number of documented migrants coming to the country because they want to preserve jobs for Americans, including union workers. I'm not saying that's good or bad. That's for people to decide. But my guess is the Trump administration might be more open, actually, to some of that human capital coming to America to drive our workforce, to create more taxpayers so they can pay into our Social Security and Medicare trust funds. So that's my hunch, but we shall see.
And I guess this is a question of mine, Bob. So you went back to R&D capitalization. You talked about the fact that there's a proposal out there. It may go away. It might allow immediate expensing again, going back 2 years. How likely is that to happen? Because I think it's really hamstrung our clients from a cash flow perspective and tax planning perspective. So I know that's top of mind for a lot of people. So where do you think that will be, and when do you think that possibly could go through?
Sure. So, prior to the election, I would say that there was no chance that it was going to be repealed, and definitely, even if it was repealed, wouldn't be retroactive. Now, with, you know, the Republicans' presidency, the Senate, looks like the House, I wouldn't be surprised if something passes, okay? And if it is repealed. So I think so my thinking's changed. I think there's a good possibility that it will be repealed. On the retroactive side of it, you know, I think that's, I would give that less probability that it would be retroactive. But as I mentioned earlier, that is in the most recent act that was proposed to make it retroactive to 2022.
Well, I think if the comments you made before, and it does come down to C corps being taxed at that lower, even 15% rate, then you really have some serious considerations of whether or not you want to move from pass through to a C corp. I mean, that's another further significant change in terms of tax, even with the considerations of double taxation in terms of the dividends and whatnot. I would think that it would still be at least worth an analysis. I know when it went from, you know, the higher rate down to 21%, I know we did a lot of analysis for clients in terms of, you know, what does 199A mean in this grand scheme of everything. But again, even with both 199A at play and the reduction, if there is a reduction to 15%, I think there is serious consideration if more and more companies should move towards the C corp.
Just another question came in, or I guess two questions. Is there any reason for a small business under 10 million, under 50 employees to be a C versus an S? I think this is what John was just talking about. I think, and I'll hand it to you, Bob, but this is obviously, we can't really answer at the granular level without more details, but Bob, I'll hand it off to you.
Yeah, it's you're right. I mean, it's an analysis that we can perform and basically do a side by side, you know, C versus S. But I agree with John on his point that, you know, from a corporate perspective, we've gone from, you know, a 35% corporate tax rate to 21%, now potentially down to 15%. So definitely something that should be looked at without doubt.
Right, and then on the AI robot grant that we talked about, is that Mass Tech Manufacturing Grant? Yes. There's others available, so we can help with that. Let's see, for a closely held $25 million wholesaler, the biggest needle mover was the TCJA, and specifically the change of accounting method from cash to accrual. What do you think will be the biggest policy change in terms of impact on those smaller, closely held wholesalers? And I guess maybe to refine that question, maybe it goes back to the S corp and the deduction, the 199 deduction, right? So one big issue you can see is, hey, if I'm a C corp, I'm at 21 down to 15, but I'm an S corp, I want to stay an S corp for various reasons. Where's my benefit there?
Yeah, I think it's a balance, right, between, you know, weighing the tax benefits versus the non-tax benefits, right? So I think it really comes down to the facts and circumstances for each company, Mark. But you know, that's obviously something that we can help with.
I think that does it. James Rocker, thank you for the comment. Great job, Eric. I think that does it for the Q&A section. So I think we lost John for a second, so I'll kind of close things out. Just want to thank everyone on the panel. I mean, I feel like this is really fantastic, and a lot of questions kind of came through at the end. So really got a lot of people thinking about this. If you need help with anything, we're all here and available to help you. So feel free to reach out to any single one of us, and enjoy the rest of your day. Thank you, everyone.
Thank you.